Business purchase and merger. How to start and finish studying. Have a bird's eye view of the entire syllabus. Study each topic thoroughly. Work out example illustrations and exercises. Repeat until you understand. Practice exam questions. Practice mock exams. Simulate exam conditions and practice. Business purchase and merger. In this lesson, we learn everything about purchase of business by another, merger of two business, purchase of business versus purchase of asset, goodwill arising on the purchase of business, journal entry in the books of purchasing company, preparation of a statement of financial statements subsequently. Altogether, we discuss and practice questions based on these concepts. Identify and practice examination problems. The difference between the purchase of a business by another business and the merger of two businesses. Merger, where two or more independent businesses combine their assets and form a completely new business. This chapter will look at two aspects of the business growth. The first is the merger of two existing businesses to form a single larger business. The second is the purchase of existing business by another business. This will result in the closure of business being purchased and the expansion of the business which buys it. There are three possible situations you can be faced with. The merger of two sole traders or to form a partnership, the purchase of business of a sole trader by a limited company, the purchase of a partnership by a limited company. The first thing to consider is the merger of two existing businesses to form a single business. This can be either two sole traders who join together and merge their business to form a partnership, or it may be a sole trader and a business merging to form a single business. Sometimes one or both of the partners may also add a value to the goodwill on the assets and liabilities they introduce into the new partnership. This is inherent goodwill and should be written off as soon as possible. The procedure to do this is identical to that discussed in chapter 18. The capital account of each partner is credited with the value of goodwill they introduce in the new business. It is then debited with the goodwill written off in the profit sharing ratio. What is the difference between the purchase of a business and purchase of the assets of a business? It is important to distinguish between a company buying the assets of another business and the purchase by a company of that other business. Some students get confused between the different kinds of purchase. A company may buy the assets of another business which may then cease to trade. Instead, it may only buy some of the assets of the business and seller may still continue to trade. This is different from the company buying another business. In this case, the company takes over the assets and liabilities of that business together with its customers and carries on trade of the business taken over. The distinction is important. The purchase only of assets does not involve any payment of goodwill. The purchase of entire business usually does involve payment for goodwill. When a limited company purchases another business, it will usually pay for it partly by cash and partly by shares. The shares may be issued at a premium. However, the seller of the business would not pay for the shares given to them. Sometimes a sole trader or a partnership may decide to convert their business into a limited company. This is done by forming a new company which purchase the business. Goodwill. As we have seen, goodwill was considered in section 18.4 and 18.5 and again in examples above. It is now necessary to consider it again in the situation where a business purchases the business of a sole trader. Unlike someone who continues to run the business, quite often the existing business owner or owners in the case of partnership sell their business to limited company and retire. In some cases, the old owner or owners may become managers in the new business. When the company purchases the business, it will usually buy the assets less the liabilities and an agreed valuation. In addition, it usually pays for the advantage of acquiring an established trade. The company does not have to build up new business from nothing. The business has been built up by the previous owner, who will normally expect to be rewarded for their efforts. Often, the total purchase price paid by limited company will be in excess of net book value of the assets acquired by them. In this case, the goodwill rises. Goodwill is the amount paid for acquisition of a business in excess of the fair value of its separable net assets. The term separable net assets is used to describe the sale of individual assets and using the money to settle the liabilities of the business. It is important to distinguish between purchase goodwill and inherent goodwill. Purchase goodwill has been paid for, inherent goodwill has not been paid for, and will arise, for instance, if a trader decides that he wants to show the goodwill of his business in his statement of financial position. He debits a goodwill account in his book and credits his capital account with any amount that he wishes to show as goodwill. International Accounting Standard 38 sets out how goodwill should be treated in the books. This was discussed in section 18.4 when it was only seen that only purchase goodwill is shown in statement of financial position. Inherent goodwill is never shown in the financial statements. It is written off. If the amount paid for purchase is less than the fair value of the separable net asset, the difference is called negative goodwill. This is known as bargain purchase, and the business and the profit recognized immediately in the income statement of the company buying the business. Goodwill is the difference between the value of the net assets acquired and the purchase price paid. Only purchase goodwill is shown in the books of account of the company buying the business. Purchase of sole trader by a limited company. Second situation you may need to know about is when a sole trader sells his business to a company. Before any entries for the purchase of business are made in the company's ledger account, the transaction must be recorded in the company's journal. The entries should include the bank and cash accounts if these are taken over. However, the bank and cash balances of the business being acquired are not usually taken over unless a sole trader or partnership converts their business into limited company, such as in the case of only take into account the assets and liabilities being bought by limited company when calculating the value of purchase goodwill. If you are required to prepare journal entries in the company's book to record the purchase of business, do not show the entries in the books of business being taken over. Make sure you prepare the journal entries in good form. Show all workings when preparing the company's statement of financial position of the after the new business has been acquired. Purchase of a partnership business by a limited company. This is the third situation you must know. The purchase of partnership business by a company follows a similar procedure to that purchase of sole trader's business. When one of the partners have made a loan to the firm and the company takes over the loan over, it is usual for the company to issue a debenture to the partner concerned. If the rate of interest on the debenture is different from the rate previously received by the partner on the loan, the amount of the debenture will usually ensure the partner continues to receive the same amount of interest each year as previously. To calculate the amount of debenture, find the capital sum at the new rate which produces the same amount of interest. Multiply the amount of the loan by the rate paid by the partnership and divide by the rate interest on debenture, as shown in the example. When a debenture is issued to a partner and the partner is to receive the same amount of annual interest as he or she receives before the sale of the firm, check that you have calculated the amount of the debenture correctly. You may be required to show entries showing the closure of the partnership books. In this case, all the closing entries are shown in realization account. The procedure is exactly the same as the dissolution of partnership in section 18.18. Notice that even when the business is sold at a figure higher than the book value of the assets taken over, it is treated as a profit on realization and not the goodwill in the partnership books. In this case, the shares are divided between the partners in the profit sharing ratios. This may not always be the case. You may also need to include partners' current account. The balances on this account should be transferred to the respective partners' capital accounts. They may also be an asset taken over by a partner on the closure of the business, say a car at valuation. In this case, credit the realization account, debit the partner's capital account with the value of the asset taken over. Return on investment. It is important that a company purchasing another business succeeds in making the new business as profitable as its existing business. Profitability is measured by expressing profit as a percentage of capital invested. If a company has purchased a business for $1 lakh and the business has made a profit of $12,000 in the first year, the profitability is 12%. This is the return on capital invested. If it is equal to or more than the return on capital employed the company was earning on its business, the investment may be considered to have been worthwhile. If it is less, overall profitability will be diluted or decreased. However, it is better to measure the profitability over a number of years to get a reliable picture. The new business may have been merged with the existing business so closely that separate results for the new businesses are not available. In such a case, the incremental, that is the additional profit, is measured against the additional capital invested in the business.